Hey everybody, Dom here, the president of the And Asset Company, and today we are going to talk about what is base insurance. All about that base. No treble, no PUA or term rider or any fancy thing that we put on it. And the reason I say that is because we are going to discuss what base insurance is, which is the basic foundational piece of essentially overfunded whole life insurance. And there are going to be other riders that we are going to put onto a policy, such as paid up additions rider, such as term riders. Those riders are allowing us to capitalize to have maximum cash and to grow our policy at a higher internal rate of return and rate of return by having those riders on it. But what we're going to focus on is just the base insurance piece. See, it's important for you to understand the characteristics inside of an and asset slash overfunded whole life insurance because it can give you a thought process of how should it properly be structured and how should it properly be designed. Since we're just going to talk about base in this policy in this video, we're going to have a little series discussing the and asset more in depth in regards to what is each characteristic in regards to the and asset. So we will talk about the term rider, we'll talk about paid up additions and any other riders that are important. But in this video, we're just going to keep it super simple and talk about base insurance. All right. So when you think of whole life insurance, you think of somebody like a Dave Ramsey or Susie Orman talk about that whole life insurance is a terrible place to store dollars and store capital because it's an overcharged, very expensive place to store capital and an over expensive, very expensive death benefit at the end of the day. And Dave Ramsey, I'll give it to him. He's a little bit right, or he's a lot of right in this instance. And it's all circumstantial in regards to how the policy is specifically designed. But if we are only having a policy that is all base insurance, that means what we have done is we have maximized the amount of death benefit we can get. So we've made our death benefit as large as possible, this massive death benefit, and all of it is essentially paying for that death benefit because the base, I want you to think of base as death benefit. And in insurance contract has to have base insurance into it to be considered insurance. And if it doesn't have base insurance into it, well, then it's just not life insurance. And at the end of the day, if we want to get our tax advantages and we want to have all these other things into it, it has to be life insurance. And the IRS must know that it is life insurance at the end of the day. So just think of base insurance as death benefit. And if we have 100%, because I'm going to talk a lot about percentages, if I talk about 100% base policy, that is 100% of our premium. So if I have $100,000 of premium going towards our base policy, which is the typical financial planning world where we try to get this massive death benefit, we put in $100,000, we get as big a death benefit as we possibly can. And that is going to just go 100% towards that, which means we're going to have very little cash value that's going to be built for us in the first few years. A lot of the times you'll see, well, actually in the first 3 years, you'll see that there will be zero cash value because there is so much money going towards that death benefit in the beginning to essentially pay out having a never ending death benefit that is extremely large. So I hope that gives you a good baseline. Just think of it as the baseline piece, the foundational core piece of whole life insurance is the base insurance, all about that base, all base, no trouble. I hope that helped. I hope that gave you some understanding of what essentially the first key foundational piece of an and asset is, which is base insurance.